Right, you know that moment. You get your paycheck, you see the big number at the top, and then your eyes slide down to the much, much smaller number you actually get to take home.
Hmm.
And the first thought is always, where did it all go? Or maybe it's tax season, and you're either doing a happy dance about a fat refund or, bracing yourself for a surprise tax bill.
Right. And what often dictates that outcome way before April 15th is a form most of us see but maybe don't fully get. Form W-4, the Employee's Withholding Certificate.
Exactly. It's not the form you file with your taxes, but the one you give your employer that tells them how much federal income tax to pull out of, well, every single paycheck.
Precisely. And what's really fascinating, I think, is just how much control you actually have over that withholding. Getting it right can really impact your financial health all year long.
Yeah. How so?
Well, it's not just about avoiding a tax bill, though that's important. It's really about optimizing your cash flow, making sure you're not essentially giving the government an interest-free loan with your own money.
Okay, so our mission today, our deep dive, is to sort of demystify this form. We want to walk you through it step by step, show you how it works, but also, crucially, how you can use it strategically. The goal, to make sure the correct amount of tax is withheld, which ultimately means putting more money in your pocket when it helps you most, especially using those credits and deductions wisely. Really zeroing in on, tax-saving opportunities within the form itself.
That's the heart of it, empowering you, the listener, to make informed choices that directly shape your financial picture. So let's start at the beginning, the foundation. What is the W-4 really for?
Okay, so at its most basic, it's the instruction sheet for your employer, right? Telling them how much federal income tax to hold back.
Exactly. It's your direct communication line for payroll withholding. It translates your tax situation into those regular deductions.
And getting that wrong, well, the consequences aren't trivial, are they? It's more than just a little oops.
Oh, absolutely. The stakes are actually quite high. If you withhold too little tax during the year, you're almost certainly looking at a tax bill when you file.
Right.
And if that bill is big enough, you could even get hit with an underpayment penalty from the IRS, which just adds insult to injury.
Ouch. Okay.
On the other side of the coin, if you withhold too much, you'll likely get a refund. Now, a refund feels nice, doesn't it? Like a little bonus.
Yeah. Who doesn't like getting money back?
True. But from a financial optimization perspective, it means you've essentially given the government an interest-free loan for months, maybe the whole year.
An interest-free loan. That phrase really does kind of hammer it home. When you think about the opportunity cost, why give away your money for zero return?
Exactly. Think about it. If you're carrying, say, credit card debt at 18% interest,
Yeah.
every dollar you over withheld could have been chipping away at that debt, saving you actual money on interest right now. Or maybe you're trying to build an emergency fund.
Right. That loan to the government just slows you down. It delays your own financial security.
Precisely. It's about optimizing the liquidity, the usefulness of your cash flow. And to keep that flow optimized, you absolutely need to know when to update your W-4. It's not a one-and-done thing.
Okay, so it's not set it and forget it. What kind of life events or financial shifts should make someone think, okay, time to look at my W-4 again?
It can be major milestones, but also subtler shifts. Anything, really, that could change your overall tax liability for the year.
Like what specifically?
Well, the big ones are changes in marital status, getting married, divorced, becoming a qualifying surviving spouse. That's huge.
Okay.
The number of jobs you have, or if your spouse starts or stops working, that's another really common one. Having a baby or, if a dependent situation changes.
Right, because that impacts credits.
Directly. Yeah. Also, big changes in other income, not from jobs like maybe you started getting significant dividend income or had large capital gains, or even just changes in the deductions or credits you expect to claim. If you want the really exhaustive list and details, IRS Publication 505, that's Pub 505, Tax Withholding and Estimated Tax is the place to go. It's incredibly helpful.
Pub 505. Good tip. Okay, let's dive into the form itself then. Step 1. Personal information and filing status. This feels like the absolute basics, the starting point. Name, address, social security number.
Seems straightforward, right? Just fill in boxes.
Yeah.
But there's actually a really crucial detail in Step 1B about your social security number.
Oh, what's that?
The form specifically asks, does your name match the name on your social security card? This isn't just like a casual question.
Okay.
If the name you put on the W-4 doesn't exactly match the name the Social Security Administration has, that can cause real problems down the line. It's fundamental for making sure your earnings get credited properly which affects your future Social Security benefits.
Wow, okay. I wouldn't have thought that was so critical. So what do you do if there is a mismatch?
You need to contact the SSA directly. You can call them at 800-772-1213 or go to their website, saa.gov, and get it corrected. It's a really important foundational check.
Good to know. Okay, so after the name check, we get to step 1C, which seems like one of the most critical choices on the whole form, your filing status.
It absolutely is. It's a cornerstone decision. This choice directly impacts the standard deduction amount and the tax rate brackets your employer uses right from the get-go. A mistake here can throw everything off.
So let's break down those options. There are three main ones, right?
Correct. First, you have single or married filing separately. This is for you if you're unmarried or if you're married but choose to file separate tax returns from your spouse. The withholding will be based on those specific rates and deductions.
Okay.
Second is married filing jointly or qualifying surviving spouse. This is for married couples filing one return together or for someone who meets the criteria for a qualifying surviving spouse after their partner passed away. This usually gives you the largest standard deduction and the widest tax brackets.
Makes sense.
And the third option is head of household. This is for unmarried folks who pay more than half the costs of keeping up a home for themselves and a qualifying person, like a child or another dependent.
So like a single parent paying most of the bills.
Exactly. This status generally gives you a larger standard deduction and better tax rates than filing as single, recognizing those household responsibilities. Choosing the right one here ensures your withholding starts off reflecting that reality.
So picking the right filing status is huge because it sets the baseline for how much tax is initially calculated.
Precisely. It's your initial declaration of your basic tax profile. Get this wrong, and the error just compounds to the rest of the calculation.
Okay.
And just a reminder, something the form itself points out if you're filling this out mid-year or expect to work only part of the year or had big life changes. That IRS tax withholding estimator at irs.gov W4 app is really your best bet for accuracy.
Right, the estimator tool. We'll definitely talk more about that. Okay, that handles the foundation. Let's move to part 2. And this is where it can get a bit more complex for a lot of people, right? Step 2, multiple jobs or spouse works.
Yes, this is a really common situation, and frankly, it's where a lot of people accidentally end up under withholding tax. It's a major pitfall.
Why is that? What's the core issue?
The fundamental problem is this. The correct amount of tax you owe depends on your total income from all your jobs combined.
Okay.
But each employer's payroll system, by default, calculates withholding, assuming that job is your only source of income.
Ah, I see.
So if you have 2 jobs, or you're married filing jointly and your spouse also works, each job is withholding based on only part of the picture. Your combined income pushes you into higher tax brackets much faster than either job's calculation alone would predict.
And that leads to not enough tax being withheld overall.
Exactly, which leads to that nasty surprise tax bill in April.
Okay, so the W-4 tries to address this in step 2 with 3 different options. Let's unpack those.
We should. Understanding the differences is vital. Option A is the one the IRS heavily recommends. Use the IRS tax withholding estimator at www.irs.gov W4 app.
And you mentioned this is their top pick for accuracy.
Absolutely, and for good reason. It's the most precise because it looks at everything, your total household income from all jobs, yes, but also things like self-employment income, dividends, capital gains, and importantly, the deductions and credits you expect to claim.
So it takes a much broader view.
A holistic view, exactly. Yeah. It can give you very specific instructions, maybe even telling you to put a certain extra withholding amount on one job's W-4 and nothing on the other. It asks for recent pay stubs, so it knows what's already been withheld and reminds you to check again next year. It's really smart.
Okay, that sounds comprehensive. What about option B, the manual route?
Option B is use the multiple jobs worksheet on page 3 of the W-4. This is for people who, prefer pen and paper or want to see the calculation themselves. The worksheet helps you figure out the total extra tax needed across all jobs to avoid underpaying. Now, here's the critical part, and it's marked as a caution on the form. You only complete this worksheet and enter the result, the extra withholding amount in Step 4C, on one of your W-4 forms.
Just one. Which one?
Ideally, for accuracy, the W-4 for your highest paying job. Then, on the W-4s for your other jobs, you leave steps 3 through 4B completely blank.
Okay, centralize the adjustments on the main jobs form.
Exactly. The worksheet uses wage tables from page 4 to help with the math, especially for 2 or 3 jobs. But there's another warning. If you have multiple jobs each paying over $120K, or more than 3 jobs total, the worksheet might not be enough. You should consult Pub 505 or, again, just use the online estimator.
Got it. So estimator is best, worksheet is the manual backup it needs care. What about option C? Just checking the box. That looks easiest.
It does look simplest. Option C says, check the box if there are only 2 jobs total. If you choose this, you have to check the same box on the W-4 for your other job, too.
Okay, both forms need the box checked. What does checking it actually do?
What it does is signal the payroll systems for each job to effectively cut your standard deduction and your tax brackets in half when calculating withholding. The idea is to counteract that combined income effect.
But there's a catch, right? You mentioned this isn't always accurate.
A big catch.
Yeah.
This method is only really accurate if the pay at both jobs is somewhat similar, specifically if the lower-paying job makes more than half what the higher-paying job does.
And if the pay difference is bigger.
If there's a big gap, say a high-paying career in a small part-time gig, checking this box will almost certainly lead to significant overwithholding.
Meaning too much tax comes out.
Way too much. You're essentially giving the government that interest-free loan we talked about, unnecessarily shrinking your take-home pay every single paycheck. The bigger the pay difference, the worse the overwithholding gets.
So the simple option could actually cost you access to your own money throughout the year.
Precisely. It undermines that cash flow optimization goal. If there's a big pay disparity, you're much better off using the estimator or carefully doing the worksheet to get a more precise withholding amount. Don't just default to the checkbox because it looks easy.
That's a really critical point. So estimator or worksheet for precision and cash flow, checkbox only if jobs pay similarly.
That's the takeaway. And let me just hammer home that instruction again for multiple jobs because it's so important. No matter which method you use, estimator, worksheet, or checkbox you complete, Steps 3 through 4B, the detailed adjustments on only one Form W-4.
Right, the highest paying jobs, W-4, ideally.
Yes. Leave those steps blank on the W-4s for the other jobs. This prevents double counting your credits and deductions and ensures the whole system works correctly.
Makes perfect sense. Centralize the details. Okay, let's move into part 3. This is where we get into the really strategic stuff, how you can actively adjust withholding to hopefully increase your take-home pay or fine-tune things. Step 3, claim dependent and other credits.
Yes. This is a really impactful section for your paycheck. Credits are fantastic because they reduce your tax bill dollar for dollar, unlike deductions, which just reduce taxable income.
Okay.
By accurately cleansing your expected credits here in Step 3, you're directly telling your employer to withhold less tax. This means more money in your pocket with each paycheck. It's a direct lever for boosting your immediate cash flow. A real tax-saving move in terms of timing.
So instead of waiting for that big refund check next year from, say, the child tax credit, you get that benefit spread out across the year in your pay.
Exactly. You get the cash when you earn it, which is generally much more useful. Let's look at the main credits. The big one is the child tax credit. That's $2,000 per qualifying child under 17 at year end.
And what makes a child qualifying?
Generally, they need to be your dependent, live with you for more than half the year, and have the required Social Security number.
Right.
Then there's the credit for other dependents. This is $500 for dependents who don't qualify for the child tax credit. Maybe an older child still dependent, or a qualifying relative like an elderly parent you support.
Got it. So it covers other family members you might be supporting.
Right, and it's not just limited to those two.
Oh, you can add others.
Yes. Step 3 allows you to include estimates for other tax credits you expect to claim. Think things like the foreign tax credit if you pay taxes abroad, or various education credits for college costs.
So you total up all your expected credits for the year.
Exactly. Your child tax credits, your other dependent credits, plus estimates for any others like education credits. You put that total dollar amount in Step 3. The form itself says, quite clearly, including these credits will increase your paycheck and reduce the amount of any refund.
You may receive when you file your tax return. Right. Get the money now instead of later.
That's the key benefit. Just be mindful of the income limits. For the full child tax credit and other dependent credit, your income generally needs to be below $200,000 if single, or $400,000 if married filing jointly. Above that, the credits start to phase out.
Okay, good to remember. This step seems like a huge win for families trying to maximize their monthly budget. Now let's look at Step 4. Other adjustments. These are marked optional but sound like powerful fine-tuning tools, starting with 4A. Other income, not from jobs.
Right. This section is specifically designed for income you receive that doesn't typically have taxes withheld automatically. Think interest from savings, dividends from stocks, maybe retirement income that isn't having enough withheld.
Okay, so income where you might owe tax, but no one's taking it out up front.
Exactly. And you want to cover that tax liability through your regular job's withholding rather than making separate estimated tax payments.
So it's kind of a convenience thing. Have your employer handle it all.
Largely, yes. It simplifies things so you don't have to remember to send checks to the IRS every quarter using Form 1040-ES, but it's important to know you don't have to use this. Making estimated payments yourself is perfectly fine.
Okay.
And the form includes a helpful privacy note here. If you're not comfortable telling your employer about, say, your investment income, you don't have to fill out 4A.
What's the alternative then?
You can achieve the same result by calculating the extra tax you'll owe on that income and just putting that amount as extra withholding down in Step 4C, which we'll get to. That way, the tax gets covered, but you don't disclose the income source itself.
Ah, clever workaround for privacy. Okay, let's move to 4B. Deductions. This sounds like another way to potentially reduce withholding.
It absolutely is, especially if you expect to claim deductions that are larger than the standard deduction for your filing status. We're talking primarily about itemized deductions, but also things like student loan interest or IRA contributions.
So if you itemize your deductions, maybe high mortgage interest, state taxes, big charitable donations, you want to account for that here.
Yes, because if your itemized deductions are going to significantly exceed the standard deduction, failing to account for that on your W-4 means too much tax will be withheld. You're essentially letting the government hold on to money you'll eventually get back because of those deductions. Putting an amount in 4B fixes that.
Okay, so how do you figure out the number to put in 4B? Is there another worksheet?
Yep, there's a deductions worksheet also on page 3 of the W-4. It walks you through estimating your itemized deductions for the year.
Like mortgage interest, charity?
Right, mortgage interest, charitable giving, state and local taxes. Remember that $10,000 limit, though, and qualifying medical expenses over the 7.5% AGI threshold? You add all those up?
And then compare that total to the standard deduction.
Exactly. For 2025, the standard deduction is $15,000 for single or married filing separately, $22,500 for head of household, and $30,000 for married filing jointly or qualifying surviving spouse. If your estimated itemized total is more than your standard deduction, you enter the difference in Step 4B. You could also add in other specific deductions like student loan interest here too.
And the effect is less tax withheld.
Correct. It reduces your taxable income for withholding purposes, which means less tax comes out of each paycheck. Again, it puts more money in your pocket throughout the year, a definite cash flow booster for itemizers.
Fantastic. That's a powerful tool. Okay, finally in this section, Step 4C, extra withholding. This feels like the ultimate manual override.
It really is. It's the most direct way to adjust your withholding. You just enter a specific dollar amount that you want withheld, in addition to whatever the standard calculation determines, for each pay period.
And why would someone use this?
Several reasons. Maybe it's the extra amount calculated from the multiple jobs worksheet back in Step 2B. Or, as we just discussed, maybe it's to cover tax on other income from 4A without actually listing the income for privacy.
Right.
Or, honestly, some people just prefer to have more tax withheld. Maybe they like getting a big refund as a form of forced savings, or they just want to be absolutely certain they won't owe anything come April.
So you can just pick a number and put it there?
Pretty much. You estimate what extra you want withheld each paycheck and put it in 4C. The form clearly states the impact. Entering an amount here will reduce your paycheck and will either increase your refund or reduce any amount of tax that you owe. It's pure, direct control.
Okay, that covers all the adjustments. Then we hit Step 5, sign here. Seems simple, but crucial.
Absolutely crucial. Don't skip it. The form is not legally valid unless you sign it. Your signature is your statement under penalties of perjury that everything you've put down is true, correct, and complete to the best of your knowledge. Accuracy matters, legally and financially.
Got it. Sign on the dotted line. Okay, we've meticulously gone through the main steps. Let's touch on some special situations and maybe some advanced tips. First, claiming exempt.
Right, this is a very specific status, and the rules are strict. You can claim you're exempt from federal income tax withholding for the current year, 2025, but only if both of these things are true.
Both. What are they?
First, you had zero federal income tax liability in the prior year, 2024, meaning your total tax on your 2024 return was actually zero, or you weren't even required to file.
Okay, no tax owed last year.
And second, You expect to have zero federal income tax liability in the current year, 2025. You have to genuinely anticipate owing no federal income tax for the year you're claiming exempt for.
So it's not just about last year, but predicting this year, too. Who usually qualifies for this?
Think maybe a student with a part-time job whose total annual earnings will be less than the standard deduction, or someone who retired mid-year and knows their total taxable income won't generate any tax liability.
Okay. And how do you actually claim it if you meet those tough conditions?
If you qualify, you write the word exempt clearly on the form in the space below, Step 4C. And importantly, you only fill out Step 1A, name address, Step 1B, SSN, and Step 5, sign. Nothing else.
Just this few boxes and the word exempt?
Right. And the result is zero federal income tax will be withheld. But here's the big warning. If things change, maybe you get a raise or work more hours, and you do end up owing tax, you could face a big bill plus penalties when you file.
So use with caution only if you're really sure about owing nothing.
Exactly. And claiming exempt isn't permanent. You have to submit a new W-4 by February 17th of the next year, so Feb 17, 2026. If you want to claim exempt again for that year, it needs annual renewal.
Got it. Okay, let's circle back to the IRS tax withholding estimator. We've called it the gold standard. Can we just recap specifically when it's really the best tool to use?
Definitely. The IRS itself highlights several key scenarios where the Estimator irs.gov W-4 app is highly recommended because it handles complexity much better than the paper form.
Like when?
If you're submitting a W-4 after the year has already started, the estimator can account for tax already withheld and adjust the rest of the year accurately.
Okay, mid-year changes.
Yes. Also, if you expect to work only part of the year, maybe starting a job late or leaving early, the estimator annualizes income properly.
Makes sense.
Any big life changes during the year, marriage, divorce, new baby, job changes for you or a spouse, significant changes in deductions or credits, run the estimator.
Okay.
If you have other income without withholding dividends, capital gains, Social Security, bonuses, business income, or if you might owe extra taxes like the additional Medicare tax or net investment income tax, the estimator handles all that.
And the multiple jobs situation.
Absolutely. If you'd have multiple jobs and want the most accurate withholding, forget the worksheet or checkbox, use the estimator. It's designed for that complexity.
It really sounds like the go-to tool for anything beyond a simple single job scenario. And you mentioned self-employment income specifically.
Yes, because with self-employment, you owe both income tax and self-employment taxes, Social Security and Medicare. Those aren't withheld automatically.
Right.
If you want to cover both of those tax types through withholding from a regular W-2 job you also have, the estimator is the best way to figure out how much extra to withhold in Step 4C to cover everything accurately. It prevents needing separate quarterly payments.
Very helpful. Any other groups needing special instructions?
Yes, non-resident aliens, they have specific rules. They should consult IRS Notice 1392, Supplemental Form W-4 instructions for non-resident aliens before filling out the form. It's crucial for them.
Notice 1392 for non-resident aliens. Good flag.
Yeah.
And one last check on privacy concerns. You mentioned alternatives if someone doesn't want to list other income.
Exactly. The form anticipates this. If you're uncomfortable putting specific income figures in Step 2C, or if your employer to see, you don't have to.
What do you do instead?
You can use the worksheet calculations, like for multiple jobs, or estimate the tax impact of that other income yourself, and then just enter that resulting extra tax amount directly into Step 4C, extra withholding. Your employer sees you want extra withheld, but not why. It protects your privacy while still ensuring accurate withholding.
That's great flexibility. Okay, this has been incredibly thorough. Let's try to wrap up the key takeaways. The big message seems to be the W-4 isn't just paperwork. It's a real tool for managing your money all year.
Absolutely. It's dynamic. And using it strategically, especially with Steps 3 for credits and 4B for deductions, can directly increase your take-home pay, getting you your money faster.
Which means optimizing your withholding puts your money in your hands sooner, rather than waiting for that big refund, which was just an interest-free loan you gave the government. Yeah. And it avoids penalties.
Precisely. Get your money when it's most useful, avoid penalties. And for anything complex, multiple jobs, other income, life changes, that IRS estimator is really your best friend.
So here's something for you, the listener, to think about as we finish up. How much could you really do with that extra money in your paycheck each month instead of letting it sit with the IRS until next spring? Could it help you hit a savings goal faster? Pay down that annoying high-interest debt? Maybe even start investing a bit sooner?
It really prompts an important question. Now that you understand the W-4 better, is your current withholding actually optimized for your financial goals this year? What's maybe one small change you could consider making, or perhaps just taking 5 minutes to use that IRS estimator right now, based on what we've discussed?
It's your money, after all.
Exactly. Understanding your W-4 is a fundamental step in managing it wisely.